Okay, welcome back. 100 points lower, 24,920 is where we are at. So it's a full 100-point cut now coming through. Aditya Sood is with us, fund manager, InCred Asset Management. He's with us now to take us through what he's making of things. Aditya, good afternoon. Good to have you here with us. And it's always an interesting conversation because we end up talking about specific names, and through specific names understand your thought process about at least a bunch of industries as well. So many of what we've discussed in the past in terms of specific ideas have been in the news one way or the other. Newland Laboratories saw a sharp move recently on the Tejas Network, not exactly defense, but we've discussed this stock in the past. On the hospital side, Indraprastha Medical. What's keeping you busy? What looks out of what we've discussed, and about 5 or 6 names on my radar? I'm gonna throw it open to you, Aditya. What looks very attractive? Because broadly markets have come up very sharply. Although there are individual names, of course, where things will be attractive and you can justify based on valuations and the story, etc. Go on.
Thanks for having me on the show. Essentially, so if I have to sit back and think about markets today, I think so. There are certain themes which are very, very long theme stocks. The story might, play out over a 3, 5, 10-year period. Obviously, there have been, temporary hiccups in, companies like Newland because that, but, I think so. The management amply clarified that this year is going to be, essentially very, very subdued for them in terms of performance. So what we have been doing essentially is we are trying to understand how deep the moats are getting. If you look at the CDMO space in India, we clearly like that space. This is the first time in last at least 10 years when we have seen all the 6 big pharma. So that comprises obviously of, biggies like, essentially Merck, Eli Lilly, Roche is returning to India. That is what I've been told by industry sources after 10 years. And the biotechs. Obviously, the biotech trends in the US are, sort of accelerating at this juncture. So we like a CDMO as a theme. What we are trying to figure out is that, let's say if China is a key competitor, which is essentially, WuXi, and WuXi, as you are aware, is having, more than 50-60% market share in all the new drug development in the world. What we are trying to understand is which are the real capable companies. Obviously, we saw, DV's announcing a very large deal with Eli Lilly for GLP-1. So we believe that Indian companies are capable. There is a 3 to 5 to 10-year runway in this story. Valuations, I would say, are still very, sort of reasonable in this space, particularly for a company like Newland. Essentially what we have liked, and we have been, holders for Newland since, 1,200 rupees upwards. The second question here is that, what happens to cost of production? So this is China +1 for sure, but this is also Europe +1. So this is one theme that we like. We also continue to like the hospital sector, particularly, Indraprastha Medical and the HCG that we hold in the portfolio. We believe that, valuations are a bit challenging in this space, and that is why we have resorted to owning, stocks wherein we see limited scope for PE multiple re-rating to come through. And we like the product space, under IT services bit. IT services obviously is getting, sort of disrupted. So we like, companies like Intellect. What we have seen in the previous quarter is that, they have reported the highest margin ever in their history, which was like, closer to 28%. This used to be a 20% margin profile company for the longest period of time. 6 quarters, they were stuck in that margin range of, 20%. And that is why we have seen such a sharp re-rating in the stock.
Aditya, just a quick word on HCG. Where are valuations at compared to other? It's a cancer specialty hospital. But where are, and of course now there is the financial investor changed hands recently. Where are valuations? Is it an efficiency story here? What's the play?
I think so. Cost takeout obviously is a play. Capital allocation is obviously a play here. If you look at, they can possibly, look at a divestiture one of the businesses here, which is the fertility side of the business. Obviously, they have done one divestiture in the past. So we see the financial investor, being super, super focused on margin improvement. If you look at, the valuation of HCG, and if you compare it to, let's say mid-sized hospitals, what we find very interesting here is that, it could be a very, very credible play going forward. Obviously, the average revenue per occupied bed or the ROCs are not as high as a full-scale, full-service hospital. But we believe that there is significant room for return on capital employed, at least 5 percentage point over a 2-3 year period to come through. And this should be coupled with margin improvement as well.
Aditya, hi. We've spoken about Tejas Networks in the past. You've liked it. You've explained why you like it. The stock is corrected now post the Q4 earnings, the big loss that it reported. So stock fell from 900 down to 700. Did you buy the dip at these levels? Is that a good opportunity now, the current price?
Yeah, so we do believe, we have obviously bought the dip. We do believe it is a very, very credible and a good opportunity for very simple reasons. If you look at the loss that they reported in the previous quarter, a part of that loss was a write-off on inventory, which was a fairly large number. It was like in the vicinity of, 150 odd crores that they reported. I would like to believe that this is a one-off, because if a company which has, sort of generated 4,000 crores of incremental revenue in the last 3 years, possibly, writes off inventory essentially because of obsolescence, I would like to believe that that was a one-off. Secondly, one has to look at the R&D spend that they are currently incurring, because, part of that gets capitalized. Our view is that, and thirdly, there is a ESOP cost also, which is very, very heavy in the case of Tejas Network. So our belief is that, this has become a stock wherein the market would like to believe that, they have an order book that needs to be backfilled. And our understanding, as far as our understanding goes, we believe that there are 3 critical elements of order book going forward. One is the, obviously the additional rollout from 1 lakh sites to possibly, 2 lakh sites for BSNL to be very, very competitive for the, 5G offering. I think so. It is all a question of time. The telecom minister has clearly said that there is no need for India to look at foreign equipment as far as the BSNL rollout is concerned. So that is point number 1. This could be a 12 to 14,000 crore opportunity. There is a 4G, 5G upgrade opportunity, which could be a 4,000 crore opportunity. There could be a BharatNet opportunity. Interestingly, Tata's acquired Tejas because of the BharatNet opportunity, but we have not seen Tejas declaring any orders from BharatNet. We have already seen system integrators declaring orders like, Nagarjuna or some of the packages in Tamil Nadu, what we have seen. So essentially, our belief is that there is a tangible opportunity of 15 to 20,000 crore, if not more, coming through, wherein, Tejas has a right to win. Obviously, there is no significant competition here. So our belief is that, the stock should bounce back. Another thing that I would like to point out today is that, if you look at the market multiple of Tejas, which is essentially in line with the market multiple, which is like 20 PE. Our belief is that, going forward, it is very difficult to lose money in PE rating. And as the earnings trajectory of this company changes, now, the good thing is that, they continue to reinvest very, very heavily in R&D. You have a R&D headcount of 1,350. So last 4 years, practically, they have trebled the R&D headcount for this company. That tells you that they are building serious capability for next 3 to 5 years.
All right. Hi, Aditya. Good afternoon. Got that point with regard to Tejas. You continue to remain positive on the prospects on various aspects. Big pool. They could win some orders out there as well. Got that on Tejas. Let's talk about one sector that's been the hottest, because of the skirmish we had with Pakistan on the border. That is the defense pack. I recall in the past, you had one stock that had some exposure out there, was BEML. This could be a few months or so ago. How are you all playing this theme, defense? Because suddenly, a lot of interest out there, plenty of stocks are running away. Something that you all have got?
Yeah, so BEML is something that we are structurally very, very positive on. I think so. They have got capability both on the defense, mining, the transportation side, all the 3 themes that we like. There is a cost takeout play here. A lot of employees are getting, retired every year, and what we are keeping a very, very close, watch on the employee headcount here. On the other defense names, we are of this view that, the rally has been very, very sharp. And we are looking at second derivative plays here, not necessarily pure play defense companies, because most of these companies continue to trade at, anywhere from 10 times revenue to 20 times revenue. Obviously, we have seen a very, very sharp up move in companies like IdeaForge, wherein obviously Streets continues to believe that, orders should significantly ramp up going forward. But our view is that, it is better to play defense through EMS plays. We have Centum Electronics in the portfolio, which is obviously a very credible play on both defense and space. Obviously, the stock has done well.
That's BEML. Let me ask you about those second order plays. Aditya, hi, good afternoon. Surabhi here. So you're saying that you'd rather look at second order plays, not the obvious names that have run up. So if you could just expand on that, what do you mean? I mean, how else would you look at playing the defense opportunity?
So Centum is one such name. If you look at what is a problem in the defense business, obviously it is the lumpiness of the business. We have seen this 40,000 crore of, sort of emergency procurement coming into play. So Centum is obviously qualified as far as aerospace and defense. Obviously, you need to see the capability of these companies. The good thing about, the EMS plays here is that essentially it is a combination of, the ITAR approval. Very few companies would have that approval in terms of, either servicing it to, essentially Boeing or Airbus over a period of time. So I think so EMS is a better play indirectly to play today. And once we see, some bit of correction, clearly defense names need to be bought on correction. But one needs to be very, very careful about the lumpiness of, the balance sheets. Working capital completely tends to get stretched. Clearly, we like, BEML or BEL, as a forefront defense player.
Okay, BEL and BEML. Got it. Good conversation. Thank you very much, Aditya, for being with us today and taking us through some of those interesting themes. We do have to take a quick break, come back on the other side. As always, a check on dealing rooms. We'll have Nimesh joining in with all the D Street chatter. And of course, then some final half-hour trading ideas coming up.